Okay, so today we are diving into a really fascinating accounting standard, IAS 28. Now, I know what you might be thinking fascinating accounting standard, but trust me, this one tackles a super common business situation that can get really tricky really fast. Let's get into it.
So imagine this. Your company invests in another business. You don't own the whole thing, so you don't have total control. But you're not just some silent partner either. You've got a seat at the table. You have influence. The big question is, how in the world do you show that relationship on your financial statements? Well, that is the exact problem that IAS 28 was designed to solve. And this is exactly the world we're talking about. It's this murky gray area, that spot between being a passive investor just collecting dividends and being the one who owns the whole company, calling all the shots.
So, to make any sense of this gray area, the standard has to start with some clear definitions. And it gives us two key types of relationships to understand: associates and joint ventures.
Now, the real difference here comes down to the kind of power you have. With an associate, the magic phrase is significant influence. We're going to unpack that one in just a sec. With a joint venture, it's about joint control, which basically means all the parties have to agree on the big decisions. For our purposes today, we're really going to focus on that first idea, significant influence. And here it is, the official definition straight from the source. I want you to pay close attention to the wording here. The power to participate. It's so important. It doesn't say you control the decisions. It just means you have a real voice, a seat at the table when those crucial financial and operating policies are being made. Okay, so power to participate sounds good, but how do you measure it? Well, the standard gives us a really practical starting point, a rule of thumb, if you will. If you own 20% or more of the voting power in a company, the assumption, the presumption, is that you have significant influence. But, and this is a really big but, the standard is way smarter than just relying on a number. It knows that influence is more complex than that. So it also looks at these real-world indicators. Do you have a spot on their board of directors? Are you actually in the room when policies get made? Are your companies doing a lot of business together? Are you sharing key personnel or crucial technical info? These are the things that prove you have real influence, regardless of the percentage. All right, so once we've established that, yes, significant influence exists, what's next? How do we actually put this on the books? Well, IAS 28 tells us exactly how. We have to use a specific technique, and it's really the heart of the whole standard, the equity method. And this is the solution. Instead of your investment just sitting on the balance sheet at the price you paid, the equity method turns it into a living, breathing number. It actually moves. The value of your investment will go up and down to reflect the real performance of the company you've invested in. When you break it down, it's actually pretty logical. Step 1, you start with what you paid. Simple enough. Then comes the dynamic part. Step 2, if the other company makes a profit, your investment's value goes up by your share. If they have a loss, your investment's value goes down. And step 3, if they pay you a dividend, you have to reduce the value of your investment. Why? Because the equity method sees that dividend as a return of your investment, not a return on it. And if you're wondering why we even bother with all this quote from the standard says it all perfectly. Just counting dividend checks isn't good enough. A company could be losing money like crazy but still decide to pay out a dividend. The equity method forces the investor's books to reflect the real story, the true performance of that other company, which is so much more meaningful. Now, you know how it goes with any big accounting rule. There are always some exceptions to the rule, right? Not every single company with influence has to use the equity method all the time. So let's take a quick look at when the rules might be a little different. The standard carves out a few specific get-outs. For example, if you're a venture capital firm, your whole business model is different, so you account for these investments differently. Same goes if you've decided you're about to sell the investment and have officially classified it as held for sale. These are just practical exceptions for unique situations. And this right here is a really crucial point. The accounting has to follow the real-world relationship. If you buy more shares and your influence turns into outright control, you have to switch to a different accounting method. And if you sell some shares and you lose that significant influence, you stop using the equity method. The accounting literally adapts to reality. So after all these rules, definitions, and exceptions, let's zoom back out. Why does any of this stuff actually matter? Who cares? Well, it matters a lot to anyone trying to get a true picture of a company's financial health.
And there you have it, the core benefit stated plain as day in the standard itself. It is all about one thing: more informative reporting. It's about giving investors a clearer, more honest view by making sure a company's results include its share of the wins and losses from all the other businesses it influences. Okay, let's just recap the big points really quickly. First, IAS 28 shines a light on that confusing middle ground of investments. Second, always remember the 20% rule is just a guideline. It's the real, actual signs of influence that count. Third, the equity method is the engine that makes this all work, linking an investment's value directly to its performance. And finally, all of this comes together to give us a much truer, much more insightful view of a company's financial world. And that brings us to our final question to chew on. IAS 28 gives us a fantastic framework. It gives us rules. But as companies become more and more interconnected through all kinds of partnerships and alliances, it leaves us with this really interesting thought. In today's world, how much influence is truly significant? Something to think about.